A long time ago, there was a family that was going to retire, and they said, "Hey, I got it all figured out. This is my income, and this is my expenses. It looks great." But they forgot something.
Yes, that big inevitable something that no one plans for.
Welcome to a Wiser Retirement Podcast. Are you curious about why your $100,000 salary won't buy $100,000 of stuff in retirement? I'm Casey Smith, and today I'm joined by Financial Advisor Michaela Dowdy. Each week we bring you practical advice on retirement, investing, and planning for your financial future. Don't forget to subscribe to the podcast wherever you're listening. Let's get started. Hey, Michaela.
Hey, Casey.
How's it going?
It's been good. Yeah.
There's a lot of people passing through your conference room.
There is.
You're like
busy.
You're no longer a rising star. You're just a star.
I know. Caroline, when she first started, I feel like we were, in the summer, right back to school, like right there at that little bit of a lull. So Caroline's my planning associate. And so I think she was like, "Oh, great. We're like,
this is the easy team.
This is a great job." And now she's like, "I'm drowning."
Yes.
Not really, but we are definitely more busy than we have been. And so it's been great though, overall, and our calendar is looking good and busy. But yeah,
plus you've been doing some of my planning too, working with people that have been with me for 20 plus years. And for me, that's always hard. I'm like, wait a minute. What do you mean you'll just go meet with Michaela? What about me? What about me? What about us? But it's good. It's, we have 15 employees now, 15 team members.
Yes.
So for me, that's a lot to manage. We even have like
people.
an HR person now, which is still crazy.
You have to have like a whole much larger operations team than we've ever had, and we have a larger team altogether now, which is
everybody
really
has someone who does what they do, except for maybe just a couple of us. But there's more people doing the same thing. So it's been a fun ride. It'll continue to be a good ride. I believe we're not going anywhere. But the demand for our services has been amazing. So let's talk a little bit about planning. You're obviously a planner here. I remember a long time ago, there was a family that was going to retire, and they said, "Hey, I got it all figured out. This is my income, and this is my expenses. It looks great." But they forgot something.
Yes, that big inevitable something that no one plans for.
So what if I told you that $100,000 salary today in retirement won't buy you nearly the same amount when you're later in retirement, or $100,000 that you're making today as a young person will not nearly buy you what you think it will at retirement?
Definitely.
Right?
No, it won't.
So we plan for this, but a lot of people don't think about this. They kind of just plan right there in the now, assuming that things aren't going to inflate. Prices aren't going to inflate, right?
Exactly.
So 2022 is kind of a wake up call because things inflated so fast that people are, "Oh my gosh, eggs are costing so much more, milk's costing so much more." Yep. But really, it's kind of a silent killer. It happens very, very slowly. So I pulled some numbers down. Over the last 20 years, inflation has been mostly around the 2% mark, but there are things that are well above the consumer price index average. So if you look at college tuition, for example, now not everybody's going to have that in retirement, obviously, but it increases at 4.5% annually. That's 141% increase over the last 20 years.
Huge.
It was just huge. Childcare, that really affects young people. It increases by about 4.2% annually, 128% increase over the last 20 years. Gasoline increases at 4.2% annually. That's 128% increase also. Everyone knows this one. Cable, satellite TV, that's a 4% increase. Again, well above the average, right? Medical care, as we would expect, 3.8% annually over the last 20 years. So then if you break it out to like essential living cost, shelter and housing going up 3% annually,
That one seems so low over the last few years. I think a lot of people would argue that one almost,
Yeah.
But I know this is looking at the last 20 years.
20 years. When
exactly.
I think it was flat for such a long time.
But it is so fascinating to kind of see that fully broken out as well.
Restaurants go up 3% per year. Groceries, 2.8. Electricity, 2.9. Now, they're on the other side of this. What are things that have not? Because if you have an average of 2, then that means there's a bunch of things that are flat to maybe negative deflation. Believe it or not, apparel, only 0.2% annual increase over the last 20 years in what you pay to wear.
That's shocking.
Part of me thinks, well, 20 years, what stores have evolved that would drive down the price of clothing? I think TJ Maxx and
you have a lot of fast
Marshalls,
fashion now.
Yeah.
That I think takes up a lot of the marketplace that didn't before. So I think your department stores are much more than they used to be, I would say 20 years ago.
Your Neiman Marcus. And,
yeah.
Versus
I would say your online shopping is what's kept the,
driving the price down.
I would say.
Alibaba and Amazon. China and Amazon. Basically.
Yes, exactly. You have your Shein and all of that has really driven that down, I would say.
I have a hard time with this one, but new vehicles, 1.8% annually. Maybe it's the type of vehicle you're buying, possibly.
Maybe.
I feel like those are way more than they used to be. A Suburban in 2016 was 66,000. Now it's like 110. So,
well, and especially here recently with all of the microchip drama we had in 2022 and all of that made a lot of differences in the fact that you saw a lot higher of a price spike because they weren't able to get
recent years. That's true.
Supply out. So I don't know if maybe that's also been that more recency.
Yeah.
It has gone up versus, for 10, 15 years, maybe it was more stable.
Airfare, 1.5% annually. That doesn't feel like that just because it was kind of flat. And then we had this big spike, post COVID, and it's kind of stayed there. Yes. Especially if it depends on where you live, but especially in the Atlanta market, because Delta has now decided it's a premium airline. So it's harder to find the deals as opposed to other markets.
The Atlanta airport is one place. It is so fascinating to me being here. I was like, oh, it's going to be so cheap to fly in and out, and, ended up, it is really actually more expensive. It's almost like a premium airport because it's so busy. Yeah. I'm assuming likely those legs that, airlines are having to fight for, that essentially they're having to pay a higher dollar to get those legs. Maybe I'm totally wrong, but that would be my assumption. And so it makes the prices much more expensive.
Delta just has so much real estate that anybody who comes in, they can squash them. So if you get lucky and you're going somewhere there's a price war, then maybe that benefits you. But yeah, the other markets are much cheaper. I've noticed. Even like New York, there's so many selections, so much to select from in New York. I feel like the airfare is cheaper there than it is in Atlanta if you're originating there.
No, I would agree. Yeah. I mean, I know here lately, just since my family lives closer to Nashville and I have a dog, I have to drop off. That's kind of where I end up just flying out of Nashville. And it ends up being hundreds of dollars cheaper than a direct flight from Atlanta. It is the most bizarre thing to me, but
supply demand.
Is what it is.
All right. So we've talked about inflation and what it's causing. But let's define that. Can you define just a simple definition of inflation for me?
Definitely. So inflation is really just your money losing purchasing power over time. So essentially it's saying that, over time, as we've all seen, even in the marketplace, I'm sure if you even just think back like, oh, gas used to be $1, even, cheaper than that. Maybe I'm aging myself
I used to buy a
that.
hot dog at the ball game for a nickel.
Yes, exactly. Right. Exactly. And so it's just showing that overall, those expenses didn't necessarily, or those items didn't change in their value. It's really, they just got more expensive expensive in the sense of how many dollars it takes because the dollar overall just got weaker over time.
Yeah.
And so that's where it's really taking into effect that your money is essentially due to inflation is losing that purchasing power year over year.
Yeah. So the reality is you have to think of inflation as like a silent tax on your savings. So if you have a family member or maybe yourself are super conservative and you're putting money in a savings account, that savings account's paying you 2%, but inflation's at 2%, you're breaking even.
Yes, exactly.
Right. If inflation, reality is most people are leaving, if you're not using high yield savings, you're still under 1%.
Mm-hmm.
So if the price of, we just read over 20 years, the price of groceries are going up 3.1% per year, then you're losing, if you're getting 1%, you're losing 2.1% in purchasing power. So the first year, you don't feel it. 5 years, you don't feel it, but you down 20 years, you definitely feel the purchasing power.
100%.
And then all of a sudden, you feel stuck because you can't support yourself based off the income stream.
No, exactly.
So yeah, I think another example is it's like compounding interest working against you.
Mm-hmm.
So you think about how compounding works, where you put in $1 and the dollar has interest and it grows, and that dollar makes interest and keeps building. It's the same way with inflation. So in compounding for your savings, it doesn't feel like you're saving much or you're not getting anywhere the first 10 years, but then those last few years of savings, it's a tremendous amount of money, hundreds of thousands of dollars that are compounding, right?
It is. Mm-hmm. But then it's almost having like that inflation is the opposite of that as well, where it's, you're really like losing, you're going the opposite direction.
You're going the opposite direction.
If you're not, investing it in something that is growing, then you're really losing those percentages each year.
And I think we talk about this with clients in our planning sessions, but I know it's on the chart. It has the portfolio, design portfolio rate of return, and then it has the inflation, and then you get your real return.
Yes.
No one ever talks about what the real return is of something.
Mm-hmm.
But that's kind of the litmus test of different portfolios is what's my real return after losing purchasing power. And you have to build that into your plan. I don't have one right in front of me, but if someone needed $100,000 today and then they were retiring in 20 years, or they need $100,000 today and they're going to be retired for the next 20 years, it doesn't really matter which one how you look at it. I think the plan's probably going to say they need about $180,000, something along those lines per year in future dollars.
In future dollars. Mm-hmm.
So when you do the financial planning, you're applying, we use a 2.5% inflation rate, but you're applying that 2.5% inflation. So every single year they should be getting a pay bump.
Yes, exactly.
By 2.5%, right?
Well, yes. And then what we're also doing, is for healthcare, if they have a healthcare, well, we always break out the healthcare budget, but because we just talked about how that's growing so much more tremendously at 3.8% annually, we're taking that into account separately from even the traditional inflation at that 2.5%. We want to make sure that, as we get older, traditionally, your medical expenses are going to increase.
We use 5.3, right?
Yes, exactly. We use a much higher amount. And so you just want to make sure that's being accounted for as well. And, it's not something you're necessarily going to find in a very simple calculator online. Or, maybe you could do it in your Excel spreadsheet if you had the right numbers, but it is, making sure you're taking into account those different sectors where you're going to be spending additionally as well. And that will be a larger, cash flow in the future, especially in retirement. Yeah. And that really does skyrocket that amount of, what you need in retirement overall. Before we jump back into the episode, do you know if you are ready to take off and launch into retirement? Get your pre-retirement checklist, a free guide from Wiser Wealth Management, from cash flow to Social Security. We've got your countdown covered. Go to wiserinvestor.com/guides to download your free guide today. Now let's get back to the episode.
So we actually have a note here and I missed it. If inflation averaged 3% per year, $100,000 today is only worth $55,000 in 20 years.
Mm-hmm. Which is an insane statistic to think of, but that really does put it in perspective. And I think it's something too, where a lot of our planning software, we're talking a lot about future dollars here, and you want to be thinking in future dollars, but at the same time, our brains don't fully grasp what a future dollar is. Mm-hmm. We can say 1,000 times until we're blue in the face that your $100,000 today is actually going to need, you're going to need, 200 some odd thousand. I mean, that's a random number, but in the future, we're not fully understanding the grasp and the grip of what that 200,000 looks like. And so it's understanding that, in that present value of like, okay, well, we need $100,000 today. I know that for a fact. Well, then let's apply inflation to everything else. Mm-hmm. And then that'll actually give us the number you're actually going to need in retirement in future dollars.
Yeah. So when you look at it on a computer, in our software, it all makes sense.
Mm-hmm.
But yeah, it doesn't make sense if you just sit here and tell somebody, no, you can't retire when they. Another thing
Yes.
too, I'll bring up is pensions. So
Yes.
a lot of pensions don't have the cost of living increase built into it. So so a pension is going to be, let's say you got $50,000 a year for your pension, but it stays, especially corporate pensions, they stay at $50,000. So that $50,000 in 20 years could be $25,000 worth, really.
Exactly.
In its purchasing power. So you have to make sure that you're investing your money in a certain way that you can keep up with inflation plus a little bit more.
Definitely. Well, and that's the thing too, is it's like, even if you were to look at your first, probably like you were saying, 5 years of retirement with that $50,000 pension, you might be like, oh yes, this is great. It's going to provide easily for all of my expenses, but it's really looking at 25 years down the road. Oh, that 50,000 really doesn't make a huge dent in now what you need for retirement.
Correct.
And so it is taking into effect, eventually you will need to be pulling, more so out of a portfolio of some kind or some other sort of income source at some point, in order to make those cash flows still happen, especially if that pension does not have that cost of living adjustment.
I think a real world example is like you have pension and Social Security, which does increase with consumer price index, but you have a pension, Social Security for a husband and wife, and they need $80,000 to live on, but all the pensions, Social Security, let's say, total up to $100,000. But the software doesn't give them $100,000. The software gives them a lower number.
Yes,
might give them $75,000, and then over time it increases what they need out of that excess, and then at some point the pensions for the most part are going to be fixed. The Social Security is going to move up a little bit, which is helpful. But then it's like you don't touch the portfolio at all for maybe the first 10, 15 years of retirement. But then near the end, you need a lot of the portfolio.
Exactly.
Because of inflationary pressures. So I think we've done a good job of painting the problem, painting the picture. Now let's talk about how do we solve for that? What do we do to beat inflation when it comes to retirement and savings? I think most people would say, and you invest smartly, but
exactly.
What does that mean exactly?
No, definitely. And it's really figuring out what is that risk that you need to be taking on in order to have the growth that you need, for retirement. So it's finding that perfect balance. Some people, that is going to be that traditional 60-40 that we hear talked about. So 60% stock, 40% equities. Or not equities, 40% bonds, fixed income. Apologies. So, some people, that is going to be that traditional model. Others, depending on when you retire, it could be, even 70-30 if you're a really early retiree, or it could be, 55-45 if you're just a little bit more, hesitant in the marketplace or in the investing, market. But overall, it really is making sure that you're investing smartly to get the returns that you would need, while also making sure that you're balancing, having that, hedge as well a little bit there too, so that you can perform well across all markets, regardless of, the performance overall. So just making sure that you have that inflation protection in that way, of just participating in the growth of the stock market overall.
So stocks are good. Real estate is a good inflation protector.
Yes.
You're literally owning the asset that is probably increasing the most. And then inflation protected securities. So you can do a treasury inflation protected bonds. That is what that's referring to as part of your portfolio to help keep up with inflation. The bond market in general is not going to be your friend if there's a high inflation period. It'll hold its own as far as returns and being stable, but the price of volatility, the rate of return in your portfolio from stocks is the price of the volatility, or you pay for it through volatility. If I can spit that out right.
Yes.
so yes, you may have to take on a little more volatility and stick more to the stock side of your portfolio, but that's historically is always kept up and plus way more with inflation pressures.
Exactly.
So that kind of goes back to our second point of diversification, balancing the risk with inflation hedges, because you can be 100% stock and not be worried about inflation at all. But can you sleep at night because the market's down 60% over 2.5 years, like it was in the financial crisis?
Exactly.
So you have to find that happy place. Also, I would go back to budgeting. We don't talk about that budgeting a whole lot here, just because we're a wealth management firm and most people are pretty good at budgeting if they've hired a wealth manager, right? But understanding what is it you're buying that's subject to inflation. Yes. So if you're buying that car, well, you're only buying a car every so often, and you can choose not to buy that car. You can buy a used car. There's other alternatives. You can choose not to have every cable channel that keeps inflating every month. And
you have to have the NFL Sunday ticket.
Of course you do. And the NBA one and the NHL one. So you have to just, you pick and choose. You may decide that you're not going to participate in the travel inflation because you're going to travel differently, or you don't want to travel at all. Every family is different. So just understanding what's inflating. And I feel like prior to 2022, I don't feel like our clients really experienced inflation that much. There was less inflation if you're an older person no longer working than if you're a working person. Because you're not subject to the gas every day, right? You don't have kids in childcare.
Yeah.
Right.
College education is probably taken care of.
Most likely. So all the big inflation things didn't really hit until 22 or late 21 into 22. And that created the pressures that people are seeing now almost overnight.
Yes. And one thing that I do kind of want to note on, because I feel like we hear it a lot of times with our older clients or people that are, about to retire as well, of thinking, well, I'm going to keep it in my, and you've already kind of touched on this, your savings account at the bank. And because then it's protected from market volatility.
Right.
And the only big the risk we're talking about with this is that if it's not a high yield savings account, you're pretty much locking in losses year over year. Versus if you are invested in a diversified portfolio in the market, then you're at least participating in growth.
Yeah.
And there is an opportunity for growth. Compared to at a bank, you don't really have opportunity for growth. Now, if you're a high yield savings account, there is, growth there to a degree. But if it's just in your traditional checking savings, getting 0.01% or whatever it may be, then you're just locking in losses year over year. And even though it might seem like it's a safer investment, in reality, you're going to get down the line and you're not going to have that protection, that cost protection that you needed. And you've lost, potential purchasing power year over year. And so just to, check there with yourself as far as, looking into, yes, it may seem like the best choice, but there is a point, where yes, of course, you do have to take risks to get a return. And at a certain point, you do need that even to just protect against inflation. Yeah.
You solve this by going through our planning process. And for those who are retired and we're managing your assets, if you're withdrawing money, you're already in a cash bucket system. So you already have cash on your side, typically $50,000 to $100,000 at a minimum. You have 2 years worth of withdrawals inside the portfolio that we're managing. And then you have bonds, and then you have the equities, the stock. So in the end, you could probably go 10 years in a terrible stock environment. And you'd never have to touch the stock. Yeah. So that's where you want to once you understand that system, then you're less likely to be hoarding cash away in a low yield account with higher inflation happening outside that, which is bad. So that's a very good point. I think the last thing I'll add is just, you got to make sure that you're updating your overall retirement plan. Retirement planning is never done one time. Retirement planning is done continuously.
Yes.
And the clients who've been here a long time know, when we do our review meetings, we're really focused on that plan. The portfolios will take care of themselves. Low cost, index focused portfolios do really well over the long term.
Yep.
So it's really those regular planning meetings are so important to make sure that we're doing our job as fiduciaries, that we have we have set up the best portfolio for you only if we know what's happening in your life, and do we need to make adjustments, right?
Yes, exactly.
Unfortunately, we have sad adjustments occasionally. We have nursing home expenses. We have big ticket items that pop up. We have to kind of pivot things a little bit. But for the most part, check-ins are easy. We're not telling people you can't spend money.
Yes.
It's just making sure that everything, that the machine is running well, and there's nothing that we need to get ahead of. Right.
Yes,
That's what those
exactly.
review meetings are for. So really, I think our takeaways are, you have to think about future dollars, not today. We do that well in our planning process. You can't do retirement planning simply by calculating, this is how much I have. And some people will do that, but I think what's happening is they're not able to live their best lives. Correct. They're not doing the right math formula to say, hey, I could actually spend more money. Right.
Exactly.
Or I can invest a little bit differently and be able to spend more money. Run projections, obviously, that include realistic inflation assumptions. Don't be assuming 1% inflation, not even 2% inflation currently. Don't rely solely on static salary or a savings target. Planning is very dynamic. And then I would encourage you to work with a fiduciary fee-only planner. Fee-only being the key word. You don't want to get sold products.
Yes, no fee-based,
fee
only.
Yes, people will try to sell you products to solve this problem, and it's not a product problem.
No, it is not.
That's very good. Thank you, Michaela.
Of course. Thanks for having me.
And if you guys would like to meet with Michaela, talk about your inflation planning,
there you go.
She's able to do it. Although there's a long line, you might have to wait a few weeks to get on Michaela's calendar. Thanks for listening to today's episode. If you're interested in learning more about Wiser Wealth Management or want to schedule a consultation with one of our fiduciary financial advisors, you can do so by going to wiserinvestor.com or by clicking the link in the episode notes. We'll see you guys again next week.